Picture it. A job on Airtasker or Fiverr finishes, the money lands in your account and it feels like pure profit. Here's the thing most people aren't told. None of it has tax taken out, and the ATO treats it as business income. If nobody's ever explained this to you, that's not your fault. The platforms don't exactly spell it out, so by the end of this, you'll know exactly how to keep that money working for you instead of turning into a nasty surprise. Here's the number that reframes everything. If you're earning around $5,000 a month on Airtasker or Fiverr with nothing set aside, you can end up with a $10,000 plus bill plus penalties after 2 years. That's ATO guidance backed by CanStar's reporting. The reason is simple. Unlike a regular job, these platforms never withhold PAYG tax or super for you. That whole gap quietly becomes yours to cover. But here's the good news. Once you know it's coming, it's completely manageable, and I'll show you exactly how next. Your first move is to accept something simple. If you're working for yourself, even part-time on the side, you're generally a sole trader, which just means you're responsible for your own tax. Log into MyGov, link the ATO service, and check your income summary so you can see what your employer's already reported for you. Then add up your Airtasker, Fiverr, and Upwork deposits and stack them on top of that salary. That total is your real income, and it's the number everything else depends on. Now here's where it gets important. Your gig income doesn't get its own fresh tax-free threshold, it stacks right on top of your day job salary. Using the 2024-25 resident brackets, income from $1,800 to $201 to $45,000 is taxed at 16%, and from $45,000 to $135,000 it's taxed at 30%. So if you earn $70,000 in your day job, every dollar of your side income lands in that 30% band from the very first one. On $60,000 of gigs, that's roughly $18,000 of tax on the freelance side alone. And that's exactly why the next step matters so much. This is the single habit that saves people. The rule of thumb accountants uses to set aside 25 to 30% of every freelance payout for tax, plus another 10% if you're registered for GST. Open a separate savings account, and the moment a payout lands, move that slice across before you even think of it as spending money. Now, I want to be honest with you, this doesn't feel great at first, watching a chunk disappear each time, but it means that when you lodge, the bill is already sitting there covered, instead of arriving as a shock you have to scramble for. Step 4 is the threshold almost nobody sees coming. Once your combined freelance turnover hits $75,000 in any 12-month period, the ATO requires you to register for GST and charge 10% on your Australian client jobs. Export your last 12 months from your bank and your platform dashboards, add in any private clients you invoice directly, and see where you land. If you're close to or over $75,000, register through ATO online in MyGov. But here's the part most people miss. Miss this line, and it costs more than you'd think. Let me show you. Here's what crossing that line unnoticed actually costs you. On $80 and dollars of turnover, the GST you should have been collecting is around $8,000 for the year under ATO rules. Miss it for 2 years before it's picked up, and you're looking at roughly $16,000 in GST debt plus interest. And here's the painful bit. You have to find that from your own pocket because you never added it to your clients' invoices in the first place. That's the whole reason Step 4 matters. Catch the threshold early and your clients pay the GST, not you. Step 5 is reconciliation, and it matters because the platforms are already reporting you. Fiverr collects DEX to a 7 data and sends it to the ATO, which means your gross income is visible to them even after fees come out. So matching your own records isn't optional. Export your earnings and fee statements from each platform, line them up against your bank deposits so nothing's missing, and keep every invoice and receipt for at least 5 years, which is exactly what the ATO requires. Do this once a quarter and tax time becomes a 15-minute job instead of a weekend of panic. Here's a trap I see catch smart people. Don't confuse platform fees with tax because they're two completely separate hits. Fiverr typically takes a 20% cut of each transaction, according to CanStar, so $60,000 of gigs leaves you around $48,000 before you've paid a cent of tax. And here's the sting. You still owe income tax and possibly GST on the full amount you earned, not just the smaller number that actually landed in your account after the fee. Knowing that changes how you price your work, which brings me to the number that really matters. The biggest mistake I see is treating platform money as invisible side cash. No ABN, no records, nothing set aside, quietly hoping the ATO never notices. But even a modest $20,000 a year of gigs in the 30% band is about $6,000 of tax owed each year on ATO bracket data. Pretend that away and it doesn't disappear. It compounds into a lump sum bill, plus interest and penalties when the audit eventually arrives. And with the platforms already reporting your income, that day comes far sooner than people expect. The good news is that declaring properly is genuinely simpler than hiding. Now here's the reality check on what you're actually earning. Say you bring in $40,000 a year on Fiverr. You lose about $4,800 to platform fees and around $12,600 to income tax, leaving you roughly $24,600 net based on CanStar figures and ATO brackets. Spread over about 520 hours of work, that's close to $47 an hour, not the 80 plus the sticker prices suggested. That's not meant to discourage you. It's so you can price your next job knowing the real number and charge what your time is genuinely worth. Let's run it back quickly so it sticks. First, confirm you're a sole trader and find your marginal bracket. Second, apply the 20, 24 to 25 brackets to your gig income knowing it stacks on your salary. Third, park 25 to 30% of every payout the moment it lands. Fourth, track your turnover against that $75,000 GST line so it never sneaks up on you. And fifth, reconcile your platform statements to your bank and keep the records for 5 years. 5 steps, and you're already ahead of most people doing this work. If you've made it this far, you now understand something most side hustlers don't figure out until a bill lands. None of this is about paying extra tax. It's about planning for the tax you were always going to owe before it ever turns into penalties. Your one action today is simple. Open that separate savings account and start parking 25% of your next payout. And if you want to go deeper, our next video walks through the deductions you can legally claim as a sole trader. The ones that shrink that bill before you ever lodge. I'm Sophie, I'll see you there.